I know, I got one. Okay, how's everybody doing? Okay, so let's see a couple of things. Next week we have a professor for a day. Are you guys familiar with that? You guys have never had that. Okay. So they have a program, some distinguished alumni and donors. They come into to our class and they talk to you about their career as auditors, and you ask them questions, what it's like to be an auditor, what does it take to succeed, all this kind of thing. Just keeping in touch with our alumni and our donors. So we want to put on a good show for them, show them that you guys are interested, committed students. So everybody make sure you're here at 7 o'clock. The guy's name is Jeff Rosen. He's a very active alumni. He's a partner at EY. Who's I saying? So everybody be here on time and have some good questions for him. Show him you're interested. They're usually here for like an hour. It's up to him, but let's figure an hour. And then we'll take the quiz 2, because in 2 weeks is our exam. So quiz 2 is getting us ready for the exam in 2 weeks over chapters 4 through 8. Okay, so next week, I guess I'll set it for, let's say 8:15 will be the quiz. And the quiz, remember we talked about this, it'll be those analytical procedures where I give you comparative financial statements and you're looking for red flags. Does that sound familiar to everybody? We did that problem 4.55 in the textbook. We went over that together, and there's another problem. I think it's 4.58 that you can also do on your own to prepare for it. Okay, so what I'm going to do, like I said, I give you comparative financial statements, and you go through it, and you want to highlight 3 red flags. That's because you did a ratio or something, or you see the number looks off for whatever reason. You say, I want to look further into this account because, and you give me like one sentence what you think looks wrong there. Okay, so 2 sentences for each one is all you need for 3 of them. Okay, there'll be more than 3 in the problem. It's written that way, but I want you to find 3 of them. And you need to find the 3 biggest ones. Remember, risk-based auditing, we want to make priorities and be efficient. So if you find 5 red flags, you pick out the 3 that you think are the most important, and you list those as your answer. Okay, everybody understand? Any questions about that? Yeah. I'm not sure if I'll have to work out whether sometimes it comes up clearly on Canvas and sometimes it doesn't. So when I'm setting it up, I'll let you know. But yeah, it'll work out. The answer will be on Canvas anyway. Whether you have a piece of paper in front of you, I don't know. All right. So we didn't start chapter 8 last week, is that right? We finished chapter 7 and that was the end. We did. Okay. On my all right, all right. This, we got through this. Okay. Hmm. Okay, so yeah, we were going on with accrued liabilities. Okay, so what were we saying about accrued or adjusting and accruals and adjusting and accruals? Sorry, we're talking about accruals. What did we say is particularly hard about them from an auditor's perspective? Okay, we said other liabilities like accounts payable, there'll be notices to remind the client about them. They'll be getting a bill in the mail, an invoice, you owe us money. So they're not going to forget about that. But an accrued liability like interest, they have to recognize interest, whether they pay it or not, every month, every quarter, whatever. So they have to remember, they have to have controls in place to make sure they recognize interest expense and property taxes, income taxes, and all those things. Okay. So it's easier for the client to just forget about it. Maybe they wrote the check paying the interest expense, but they didn't do the journal entry because they just forgot. So as an auditor, you need to make sure there's not necessarily going to be evidence that interest expense needs to be recorded. They have to remember it. And as an auditor, you need to check and make sure that they remembered to do that, that they have controls reminding them time to do interest expense. Okay, so then moving on. How do you do these accrued liabilities and prepaid expenses? Agree from prior year work papers. We've already learned that, right? What you see, you check 12/31/24. That should be the same as 1/1/25. That's the first step you do. Verify that payments were made. Look at canceled checks, credits to the cash account, something like that. Underlying agreements. Okay, if they have a loan out, when is interest due? How do you calculate it? By a percentage or is it a set amount? Maybe recalculate it for them. Check the underlying agreement and see exactly what they're supposed to be doing. Recalculate. You guys know interest expense can often be a complex calculation. So can income taxes um, also. So recalculate that for them. Agree expense accounts to trial balance. Search for unrecorded accruals. Okay. Check cash disbursements at year end. So that could be exactly what we're talking about. They wrote a check at the end of the year paying interest, but they didn't do the journal entry to record it. So you look here, these credits to cash. Why is there a credit to cash here that doesn't have any documentation, no explanation, no journal entry? Oh, we paid interest, but we forgot to record it. Okay. Look for expected accruals at other stages, right? So you know, for instance, when they do wages and salary, when they send out the paychecks for wages, is it at once a month? Is it every 2 weeks? Whatever it is, you know, so you can check. Did they do it when they were supposed to do it? You should know the schedule and be able to check that they did that. Okay. And then, as always, analytical procedures. In this case, what would analytical procedures be looking for? How would you do that to look at interest expense? Okay, if they have the same debt outstanding this year as they did last year, then interest expense should be the same, right? Okay, if they've got the same debt outstanding as they did last year, interest expense should be the same. So look at your last year's interest expense, compare it to this year's interest expense. If they're not the same, that's a red flag. Maybe they calculated it wrong. Everybody with us? All right, income taxes. They point this out because it's obviously a very complex area of accounting. Usually you'll need a specialist to come in and help you with it. You want to vouch payments to the government, examine correspondence with government agencies. If they have some dispute with the IRS or someone, obviously you need to know about that and look into it. Follow standards for auditing estimates. Okay, I don't know if we've talked about this yet. Did we talk about that? How do you do an audit of a judgment call? When there's no bright line answer, this is the exact amount it should be. When the client has to make a judgment, how do you do that? How do you audit that? I'm sorry? Any judgment where they had to make a judgment call, an estimate of some kind. When the client made a judgment call, what do you do about it? Yeah. Right. That's right. Yeah, that's right. The difficulty is you're essentially second guessing the client. There's no right or wrong answer. Like, how did they decide the useful life of the equipment they just bought? Or when they decided whether or not to take goodwill impairment. If they said, no, we don't think it's been impaired, a lot of that is just a judgment call with estimates of future cash flow and stuff. So, did they do a reasonable job of that? How are you supposed to know? Okay. When you're doing an audit of an estimate, there are basically two rules you want to follow. First, they have a company policy and they follow it. They have a company policy and they always follow it. So, for example, when they're doing fair value accounting for their investments, they have a specialist, some finance guy who is an expert on this. It's his job just to do the valuation. It's always this guy who does it, and then the CFO, whoever signs off on it. So they have procedures. He uses some kind of software, some models to figure this. They have procedures, and they always do it that way. So they have a policy and they always follow it. And second, the estimate is reasonable. Okay, so if they just bought a truck and they claim it's going to last for 25 years, you could ask them, how do you know it's going to last for 25 years? Okay, so when you're auditing an estimate, you're in a tough position. Basically, what you do, they need to have a company policy and always follow it, and the estimate needs to be reasonable. And that's something we're going to come back to a lot in any kind of area. When they made a judgment call and you have to second guess what they did, those are the basic standards. Property, plant, and equipment. First year again, first thing again, balance to prior year documentation. 12/31/24 is the same as 1/1/25. For a purchase of property, plant, and equipment, you vouch back to the invoice or the cost records and inspect title. So that's easy enough. You vouch from the line item on the balance sheet to the invoice that they purchased a truck for so much money. You can also look at the title, make sure they own it, and vouch to board minutes. Something, if it's a large purchase, they probably have a policy. Anything over a certain dollar amount, the board of directors needs to approve before they can make a purchase of that size. So if they did something over over a certain dollar amount, you can go back to the board minutes and read somewhere the board voted, yeah, go ahead and buy this thing. So again, you're vouching back to the original records. Okay, expenditures subsequent to acquisition, vouch to the invoice and work description, and follow and consider propriety of classification, expense or capitalize. You guys remember this. Whenever you buy something, you have a basic choice. Are you going to capitalize it or expense it? You guys know one usual rule of thumb. If it's going to last for more than a year, then you can depreciate it. If it's going to last for less than a year, you can't depreciate it anyway. So what's the point? Just go ahead and expense it right away. Okay. So when they do something, so you always have that decision to make. Do you capitalize or expense? They should have a policy. Okay. If they do that, that it's less than a year, they always expense it right away, then make sure they always follow that policy. Um, if it's a materiality level, like anything under $50,000, they expense right away. Anything over that, they capitalize, then they follow that. But they need to have a policy and you need to make sure they're following it. And then you guys probably learned this example in 351 or something. When they have a car, if they put a new engine in the car, what do you do with the cost of the engine? You capitalize it because the engine increased the value of the car. But when they get oil and lube on the car, you expense it. It's just maintaining the car, not improving it. So they should be following that general rule. An expenditure subsequent to acquisition that improves the asset is capitalized. That just maintains the asset is expensed. Yeah. Well, in the end, it's a judgment call. So whatever it is, the people who work on it at least should be experts in it. They know how what kind of benefit it is, so they can decide, I guess. Well, again, there are specialized things where you're not in a position to judge. If it's a really material amount and you have questions, maybe you want to bring in an outside expert to help you look at it and decide. But and again, what you could be doing is auditing a judgment call. See, do they have someone who is an expert who made this decision for them and followed some kind of policy, or do they just wing it and say, yeah, let's go ahead and capitalize this? Why not? Okay, what about when you sell property, plant, and equipment? Vouch from PP&E to board of directors minutes. So the same thing. Over a certain dollar amount, there might be a rule that the board of directors has to authorize that they can sell it. So you should be able to look at the minutes of the board of directors meetings and see that they authorized it. Vouch to cash receipts journal and validated deposit slip. Recalculate gain or loss. You guys learned this when you sell an asset, you got the differences gain or loss. Make sure they did that accounting properly. Trace from board of directors minutes to property, plant, and equipment. Okay, you guys understand what they're talking about, right? That's vouching and tracing. How are you doing that with the board of directors minutes and the disposal of an asset? Vouching would be you start with the sale of the asset and vouch back to the original record, the board of directors meeting. Right, right. And then completeness would be what? No, you start by reading the board of directors minutes. Somebody's job, like a new hire, read the board of directors minutes, and you find they authorized the sale of an asset. Then you can trace forward and see did they in fact sell that asset. Okay, one is going from the original records to the accounting, the other from the accounting back to the original records. It's still just vouching and tracing. Look for unrecorded disposals. How would you find a disposal that hasn't been recorded? So they got rid of an asset, but it's not on the balance sheet that they sold it. Agree to prior year work papers. Okay, how would that help you? Yeah, I'm sorry. That means they got rid of something, they disposed of it, but they didn't record it. So how would looking at last year's work papers help you? Right. You see the balance this year and the balance last year. If they have less this year than they did last year, and there's no record of a sale of an asset or anything, you want to ask them what happened here. Say, oh, you're right. We sold that thing and we forgot to record it. Examine insurance policies, tax records, physically inspect and confirm the fixed assets, both existing and newly acquired items, and confirm leased assets. So there's some things they lease, some things they own. You should check the original records and figure that out. Depreciation expense. This is another judgment call, right? They decide how long is this asset going to last? What's the salvage value going to be? If they buy a car and they say it's going to be, they can sell it 10 years from now for a $5,000 salvage value. Where did they come up with that number? That's just basically a guess, right? Is it a reasonable guess or not? That's your job. So recalculate using useful life, salvage value, cost, and method. So accelerated depreciation, you want to recalculate the depreciation they're doing. Reasonableness, again, of useful life, salvage value, etc. Is depreciation consistent with company policy? Okay, so that's the other part we said. What did we say are the two things when you're auditing an estimate? Reasonable, right. So here we have reasonableness, and here that they are following a company policy. And they say here half year convention. Have any of you guys heard of that? A half year convention? You know what is it? Okay. Oh yeah, yeah, yeah. I'm sure that's similar, but yeah, that's. Let's see. I was on Makers. You say Makers? Oh, okay. Oh yeah, yeah. That's right. That's what I was. A lot of companies, so you guys know, in a textbook, when you buy a new asset, it's always on January 1st. In real life, you don't buy things on January 1st. So if you bought it on March 10th, how much depreciation are you going to take? Are you going to take 10 months? Are you going to take that many days out of 365? What are you going to do? It's not in GAAP, it's up to you. Okay, so what a lot of companies will do, they use a half year convention. If you bought it in the first half of the year, they'll take the whole year depreciation. If they bought it in the second half of the year, they'll take half a year's depreciation. Okay, that's acceptable. A lot of companies do it to keep it simple. But as an auditor, what are we looking at? If that's their policy, if that's their policy, they always follow that policy. If they have a policy, we use half year convention on our fixed assets, then they always do that. So they don't pick and choose. We want a little more depreciation expense this year, so we'll do it for the whole year. We want less depreciation expense next year, so we'll do a little less next year. Yeah. Well, you should have an invoice or something, right? I mean, if they forge an invoice, maybe you can spot it, or maybe they'll fool you. If they go to that much trouble, there's only so much you can do. We talked about you scan a document and see if it looks altered, but You might not be able to tell. Yeah. I'm sorry, I couldn't hear you. Why do the programs, the depreciation from in the ERP systems do it automatically? So I put it at January. Oh yeah, yeah, sure. If they have software, if they have a program that already does it, then that's their policy. But you can check the program and see exactly how it's done. Is it programmed properly to do it to the day or the month or whatever it is it's done? But in any case, somebody had to write the program and give it the policy that it's supposed to be following. Okay, everybody getting all this? All right, all right. Uh, Company policy, lease agreements, is it capitalized or operating? And check the footnote. Oh, and here we have another work paper. So this was PBC, prepared by client. So our client, Apollo Shoes, this is their record, and we are now auditing it. So this is for their long-term assets. They have two buildings, and one is a separate asset, building improvement. Okay, so let's see what we got here. These little tick marks next to beginning balance, they wrote PY. What's that? Prior year. What did they do? Compare what? Last year. Prior year means they went to last year's work papers and confirmed 12/31/24 was 1/1/25. Okay, added. So they made some additions to building two and the improvement, and they put a little V there. I don't know what V means, but what do you think they did with that addition? Verified that that is the amount of money that was spent. They can see work orders, receipts, something like that, that money was spent on the building. Sold, they checked that it was sold. Again, and then with depreciation, again, PY, that they agreed it to last year's balance. Okay, next to depreciation expense, they put a C. What did they probably do with depreciation expense? Calculate, I think, is probably what they did, right? Make sure if it was straight line, accelerated, how did they calculate it properly? Okay, all right, and then here they got TB by the total. What does that mean? Trial balance. What does it mean exactly? It's cross-referencing. You can go to the trial balance and find that number. And on the trial balance, it would say that you could go to work paper F1 and find this number. Okay, and then we've got a bunch of F's at the bottom. Those mean footed, and CF means cross-footed horizontally. Yeah. Where is it? Oh, here. The sold. Well, I don't know. What would you do if you sold something? You check a receipt that's actually what they sold it for. They got a check from somebody for 10,000. I don't know exactly what the E means, but that's probably what they did. They would have there's a little explanation at the bottom. What do all the footnotes mean? What do all the tick marks mean? It would say what E meant. I'm assuming if they sold it, they're looking at a check they get received for $10,000. Okay, the last topic in this chapter is payroll. When you look in your textbook, it's actually an appendix. So it's at the very end of chapter 8. You might not see it the first time you read it through, but it's there at the end of chapter 8. It's a separate topic, payroll. And we're going to go through it real quickly now. Okay, payroll is often processed by third-party service providers. We talked about that. What does that mean? That's right. You hire somebody, a third party, another business to do your payroll for you. For a lot of companies, that saves money. It can also be good segregation of duties. You get a third party involved. So nothing wrong with it. Very commonly done, especially for things like payroll. Balance sheet accounts are usually small as a percentage of the whole balance sheet. Payroll is usually small. And so you can mostly rely on tests of controls, fewer substantive tests of transactions. Okay, what does that mean exactly? Balance sheet accounts are usually small, so you rely on tests of controls, fewer substantive transactions. What does all that mean? Okay, because the balance sheet amount is small comparatively, you don't have to do a lot of actual testing of transactions. That's substantive testing. If you see that their controls are good, you do tests of controls, and you're confident they have good controls over payroll, you can do a few substantive transactions. You always want to do some. Don't do zero substantive transactions, but not a lot because you're confident in the payroll because it's not a huge dollar amount anyway. Yeah. I think what they mean is in general, financial statement analysts will tell you when you're looking at a company's whole balance sheet, the percentage of it that gets paid in salaries is pretty small. Okay, what are the inherent risks that you're worried about in the payroll cycle? All right, we already talked about ghost employees. What's that? Right. People who are getting a paycheck but don't actually work there. Okay, overpaying or padding of time and production. How would you prevent something like that? Right. You could put limits on how much they can get so they don't get overtime and something. They could have time cards that are punched in, and then you can just multiply how many hours times whatever their wage is, and that should be their paycheck. Okay. There are ways you can check that. Incorrect accounting classification. So you guys remember this will come back to your cost accounting stuff. Was it direct labor, indirect labor, overhead, all that stuff? Was it classified correctly? And you want to worry about failure to pay third parties like payroll taxes. Make sure that the taxes are all getting done properly. Okay, again, what we're seeing here, like we see in every chapter, they put in all caps here, the important documents, the audit trail over the payroll cycle. So there should be first a payroll authorization form. Okay, human resources said, okay, we're going to hire this person, put them on the payroll. You should see a piece of paper for that. Timesheets, of course, that record how much they're working. Supervisory personnel should review the timesheets and where they worked on various jobs. The payroll department has the payroll register and payroll checks. Cash disbursements, a treasurer should review the payroll register and compare it to the payroll checks. So there's a payroll department that prepares the checks, and then there's somebody like a treasurer, a separate person, who actually signs the checks. Again, segregating the duties. Payroll checks should be signed by an authorized party and distributed directly to employees. So again, it's establishment of responsibility. There is someone like the treasurer of the company whose job it is to sign the checks, and it should be only that person who is signing the checks. And did we talk about this? Why would you be distributing the paychecks directly to employees? What's that about? Yeah, that's a way to check for ghost employees. You don't have to do it all the time, but once in a while you can say, I'm going to hand out every paycheck and get a look at their driver's license before I give it to them. And if they get direct deposit, still some kind of receipt, a slip that they're getting direct deposit or something, and check that. All right, the basics of internal control again: physical controls, segregation of duties, and performance reviews. Physical controls as far as payroll. Payroll checks and signature plates kept in a secure location. All right, so blank checks. And if you use a stamp to sign it, obviously those shouldn't be just sitting around. They should be under lock and key. So as an auditor, you can check that. Payroll checks distributed by a person not involved in processing or recording payroll. Okay, again, if it was the treasurer who signs the checks and distributes them, maybe they have an opportunity to create ghost employees. So one person writes the check, somebody else actually hands them out. Payroll checks distributed to individuals with proper ID, like we said, hand them out and look at a driver's license before you give it to them. Unclaimed payroll checks are stored in a secure location. Segregation of duties. The personnel department and the hiring employee department oh yeah, here it is. Here are the basics of segregation of duties in all caps. Someone authorizes that you can pay this person, someone records, does the journal entries for payroll, and someone else has custody, like the treasurer has the paychecks. And then performance reviews, somebody reconciles the payroll account. Okay, we've seen this slide before too. Anytime you go in to do the audit, you should be able to ask the client, I need to see these files, and they'll have them because every business keeps these basic files. For payroll, what are the basic files that everybody should have? Personnel files, who's been hired, what their wages are, a payroll register, a labor cost analysis, clearing accounts. You guys heard of that? What's a clearing account? Okay, a lot of companies for payroll, they'll have one special account. When it's time to do payroll, the money will go into the clearing account, and then the checks are written out of the clearing account. And then other than that, that account is kept at zero. It's just used for payroll. Money goes in, money goes out, just to keep everything nice and neat.
Like paychecks that are cut from one period, like right at the end, like right in between pay periods.
That makes sense.
Because sometimes um, the check date will say like the 31st, but it doesn't clear until the first. So you need to like record when it came out of the bank, but you have to record the taxes.
That sounds right. I think what you're talking about is what a clearing account is for. It's just the payroll in there to keep everything neat. When you want to look at the payroll, you go to this clearing account. The checks went in there and went out of there, and that's all. It sounds like that's what you're talking about, basically.
Yeah.
What was I saying? Oh, yeah. So it's kind of like the income summary account when you're closing the books. It goes in there, goes out of there, and otherwise it's at zero. All the government and tax reports relating to payroll, year-to-date earnings, and W-2 reports. All the standard things that you should be able to see. Okay. There's one problem with chapter 8, a problem in chapter 8. Um, yeah, here. 8.54 on page 356. 8.54, page 356. This is an interesting one. Okay. You can start reading in the middle where it says Bailey Books. Bailey Books is a retail distributor of upscale books, periodicals, and magazines. Bailey has 431 retail stores throughout the southeastern states. 3 full-time purchasing agents work at corporate headquarters. They are responsible for purchasing all inventory at the best prices from wholesale suppliers. They can purchase with or without obtaining competitive bids. Okay, so we're talking about here, I think we mentioned this. A bigger business will have a separate purchasing department. Their whole job is to buy stuff when the company needs stuff. Okay, so this is one separate department called purchasing. In this case, they have 3 people in the purchasing department. One thing they just mentioned, they do not need to obtain competitive bids. Okay, you guys understand what competitive bids are. Going back to that example we did with your department wants to buy a copier. So you want to buy a copier, we decide what model and everything, and then the purchasing department has to get bids from 3 different vendors. We want this model copier, what's your price? And you take the best price among those 3 vendors. Okay, that should be an internal control. Something over a certain dollar amount, you always have to get competitive bids. Okay, these guys don't, they do it, but they don't require it. That's already a weakness. You should require competitive bids for anything over a certain dollar amount. They're not doing it. We just found one problem. The three purchasing agents are McGuire, in charge of purchasing books, Garza, in charge of purchasing magazines and periodicals, and Collins, who's also the manager of the purchasing department, in charge of ordering miscellaneous items such as paper products and store supplies. One of the purchasing agents is suspected of taking kickbacks from vendors. In return, Bailey is thought to be paying inflated prices. Yeah, okay. So what are they talking about here? They expect what are they calling? One of the purchasing agents is taking kickbacks from vendors. What does that mean exactly? Yeah, right. They send all the business to one vendor and say, in return, just give me some money back. Okay. The purchasing agent has that power if there's no check on them. So that's why I think we mentioned at the beginning of the chapter, there was a line item that said the purchasing department is a ripe area for fraud because of that. A purchasing agent making a side deal with a vendor to send all the business their way. So that's what they're worried about here. Okay, so first off, what do we see are some weaknesses in the internal controls? We just talked about the competitive bids. Okay, there are three people in the purchasing department, and they all work on separate things. They all buy separate things. There are two easy ways to make for better segregation of duties there. There are two really easy things they can do. They've got three people who each buy different things. What could they do differently to have better segregation of duties? Right. They could rotate the duties every couple of months. You start buying the paper and I'll start buying the books, something like that. That would be one way to prevent a good relationship, a kickback scheme. Right. They say here one of the people is ostensibly the manager, but it sounds like they don't actually do any managing. They're just a purchasing agent. So maybe this one manager is just the manager checking everything, and the other two are the purchasing agent. Then you've got somebody looking over everybody's shoulder. Okay, so either of those two things would help to solve the problem. Okay, and then on the next page, for the problem they put here, the auditor put together the spreadsheet. And they're going to use that for some forensic accounting to figure out who's committing the fraud. Okay, so you look at the spreadsheet here on page 357. They list here are all the different vendors and the products that you get from them. And then the last column is the percent of purchases bid. Okay, so what that means is what percentage of the purchases you made from that vendor were the result of a competitive bid. Okay, for most of the vendors, you can see it's like 80, 90%. So for the most part, they are getting competitive bids. But then a few of them stick out. One of them, Du Bois, is only 57% competitive bid. Another one, Jericho, is only 72% bid. And then another one, Orion, is only 15% bid. Okay, so most of them are 80, 90% competitive bid. This one, Orion, is only 15% competitive bid. So then you're a little suspicious. That's a red flag. Now you look into Orion a little more. 2 years ago, they bought $86,000 worth of stuff from Orion. Last year, they bought $416,000 from Orion. And this year, they bought $803,000 from Orion. So they're doing 10 times as much business as 2 years ago. Then you look at those others where there aren't a lot of competitive bids. Du Bois and Jericho, what do you notice they have in common with Orion? Same thing, and the same guy in charge. Paper, 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 and they're all done by Collins. And then look at what's happening there. 2 years ago with Du Bois, they were buying 321,000. Last year down to 218,000. This year down to 121,000. And Jericho, 2 years ago 186,000. Last year 111,000. This year down to 93,000. So what do you think Collins is doing? Giving all the business to Orion, okay, taking the other accounts that he works with, shipping all the business away from them and to Orion, which is probably the one giving him the kickback. Okay? And the way that was highlighted for you was first an analytical procedure. You look at the percentage that was bid. This one was waste, was a real red flag sticking out 15%. Yeah. Yeah, wait, right. Yeah. First of all, it's not your job to prove a kickback. You're not FBI. You are collecting evidence and you take it to the management and they do what they want. If they want to go to the police, if they want to handle it internally, that's their problem. You found this evidence and you take it to management. Okay, and the other thing, another analytical procedure was you compared it across the years and you saw that Orion is doing 10 times as much business with us as they did just 2 years ago. Okay, okay, that's chapter 8. Okay, so we have now done everything for the second exam. Second exam is chapters 4 through 8. So we are all up to speed there. We can get started on chapter 9. Or I guess we can probably finish chapter 9. We'll see what happens. Quiz this week. Like I mentioned, first we have a guest speaker at 7 p.m. And then I'm going to say, I think I'll schedule the quiz for 8:15. I mean, maybe he'll be done by 8. We'll take a break and take it at 8:15. That's kind of a guess. So I'll schedule the quiz for 8:15. But please be here at 7 p.m. This guy's an important alumni, partner at EY. So we want to make a good impression on him. Oh, the quiz is going to be that longer problem. Analytical procedures where I give you comparative financial statements. The practice problem we did was 4.55. And that's also going to be a problem on the exam. That's why we're preparing for it by doing the quiz on that. The quiz is just that problem writing. You're going to write on Canvas, red flag number 1, current ratio. I see these numbers, red flag number 2, 2 sentences, red flag number 3, 2 sentences. Yeah. Right. The exam in 2 weeks is 20 multiple choice worth 4 points each, and then the analytical procedures problem worth 20 points. Sorry, I'm a little sick. Okay, everybody feel good about that? All right, let's get to work on chapter 9. Okay, so we're continuing our chapters on account cycles, how a transaction moves through the business. We did revenue cycle in chapter 7. We just did the purchasing cycle when they buy stuff. This is a production cycle. So this is for a manufacturing company. That's a company that makes their own products and then sells them. So they have a production cycle. Okay, so what is important about this? This is dealing with the inventory account. It is a major component of current assets on the balance sheet. Errors will affect both the balance sheet and the income statement. Valuation is usually very subjective. Okay. You guys remember we already talked about lower of cost or market, right? You need to check periodically and make sure that the inventory is properly valued because prices fluctuate on the market. So you're worried about the inventory becoming obsolescent. And since the goods have not been sold, you're not sure what the market is for it. So you might have to adjust its value on the balance sheet. Okay, a simple flow chart I put together again. How does the production cycle happen in a company? First, they have a sales forecast. We expect to sell this much. We already have this much in inventory, so we're going to have to produce this much. Now we're going to plan out production, how much we're going to produce. Now you can authorize, go ahead and purchase the raw materials, the extra labor if you need it, whatever. Now you do the production to make the products. Then they go into finished goods inventory. Then you have to divide the costs up by job. And finally, you sell the stuff. So what did we do here with a flow chart? What do we call what we're doing here? We are documenting our understanding of internal controls, right? Over the production cycle. We would put this in our work papers. What's the internal controls? How does the production process work? And this is in our work papers. Here's how it works. We could also have done, what else could we do to document the internal controls? We could have written a memo, or we could have put together a questionnaire. I'm sorry? Right, a narrative, a memo, or a questionnaire, or a flow chart. Okay, what are the risks in the production cycle? The complexity of inventory accounting, for example, dollar value LIFO, susceptibility of theft. We're dealing with physical goods so they can get stolen. Movement of inventory. You got the raw materials being shipped to you in a truck or a plane or something. Then you got to move them from raw materials to production, from production to finished goods, to the showroom or wherever you're selling them. All these kinds of things can get lost, things can get damaged. So that's a concern. Lower of cost or market is complex accounting that you might have to do. And it has a major effect on gross profit since inventory becomes cost of goods sold. So you're worried about earnings management. Okay, the production cycle. First, production run should be authorized, like anything else we're talking about. Before anything gets done, there's somebody in charge who signs off and says, okay, go ahead. So before they start producing anything, somebody gave an okay. You, as the auditor, go back and check that. Every production run was authorized by whoever is in charge of authorizing production. Raw materials should be counted and inspected. So you guys know what's a transfer ticket? That's like moving some from raw materials to the production process to work in process. Okay, so when you would request, I need 10 of these from raw materials, they send them to you. So they have a form, you requested it, they fill out a form sending it to you. When they send it to you, you open up the box and count, we got 10 of what we wanted. All that should be recorded, documented. As production is undertaken, materials and labor quantities should be summarized. All inventory items should be accounted for. They were either used in production, discarded as scrap, or returned to raw materials. Okay, but careful paperwork, everything is kept track of. And you, as the auditor, check that they have appropriate forms and they're using them and they're getting signed by the right people. The whole process is working like it's supposed to. All right, transfer tickets we just did. You count and inspect the items before you sign off that you received them. And then there's a cost accounting department that does all the stuff you learned in 380, quantity of raw materials to materials requisition, quantity of direct labor to timesheets and labor distribution. So is it direct labor, indirect labor? Cost accounting applies overhead cost to production using overhead tickets. Okay, so you know they have the formula for how they're going to calculate manufacturing overhead. That gets done according to some formula. You can check that. And finally, they do job cost summaries. Okay, so there's a department that does all that, and you check their work. Okay, what are the basic files that you should be able to see? They should have a sales forecast. They should have inventory reports of items on hand, how much raw materials, how much work in process, how much finished goods. Open purchase order. We talked about that before. What's an open purchase order? Right? They ordered it, they don't have it yet. And as an auditor, what are you looking at particularly with those? They shouldn't be sitting around for a long time, right? They order something, they should be getting it and using it pretty quickly. So if you see some purchase order that's just been sitting there for 2 months, you want to follow up. What's going on? And they should have production plans and reports. Okay. How do you test the controls? Observe segregation of duties, vouch costs to labor and material reports. Okay, so what does that mean? So every job cost, there's a summary of the cost for that job, and you vouch back to the time cards, receiving reports, when they got the raw materials, how much they got, transfer tickets from raw materials to work in process. And there you can you vouch backwards to make sure, confirm the existence of all these costs on this job. Check that everything was properly authorized, like we've been saying, and examine the review of the cost report. So there should be a supervisor in cost accounting who reviewed it all and said, yeah, this is all done fine. And you should be able to see a signature or something like that. Okay, substantive procedures. So we've done the testing of controls. Now what actual testing are we going to do over transactions in inventory? We're going to observe the inventory count. We'll talk about that. Tests of pricing and compilation, and analytical procedures to look for excessive inventory and slow moving inventory. Okay, so again, when we're doing analytical procedures on the quiz, a lot of that is financial statement ratios. Here's another basic ratio. What is days in inventory? What does it tell you? For them to sell their whole inventory, right? So as an auditor, what would you use that ratio for? What are you looking for? You calculate it and then what? It takes them 50 days to turn over their inventory. Is that good? How do you, the answer is supposed to be, I don't know. How do you decide if it's good? Compare with prior years. If it's always 50 days, that's fine. If it's usually 30 days and now all of a sudden it's 50 days, not so good. Okay, so physical inventory observation. This is like accounts receivable confirmation. It's something you do in pretty much every audit. Okay, the company does a physical check of their account of their inventory. You guys know that. You are there to observe it and to make sure that the account of inventory is done and done properly. I think, did I mention the McKesson and Robbins scandal, right? With the confirmation of inventory. This happened in 1940. Did I mention it? All right. Well, anyway, so before Enron, the biggest scandal in American accounting history was the McKesson and Robbins scandal of 1940. Yeah, yeah, yeah. That's right. That's right. Right. So what they were doing for 14 years, Price Waterhouse had been giving them clean audit opinions. They claimed they had these warehouses that didn't actually exist. Price Waterhouse never went to the warehouses and looked at them. And the same thing with receivables. They claimed they had all these receivables. Those customers didn't actually exist. But Price Waterhouse didn't do the confirmation of receivables that we learned about in Chapter 7. So there were major reforms to audit practice because of McKesson and Robbins. Because of McKesson and Robbins, you always do confirmation of receivables and you always observe the physical inventory count. So you do those all the time now. It's because of McKesson and Robbins. Okay, so auditors are required, you always do it, to make or observe some physical counts of the inventory and apply appropriate tests of intervening transactions. You will usually make test counts at a time other than year end. Okay, when do most companies do their physical inventory count? Not the end of the year. Uh, no, they do it at the slowest time of the year, because they will probably shut down the warehouse for a day so that they can get an accurate count. So most businesses will do the physical count of inventory at the slowest time of the year because they're going to shut down the warehouse for a day. And so that is when you will do the observation of their inventory count. You'll be there to watch them do it. And then you will do what's called roll forward testing. Have we mentioned that? Roll forward. Okay, that's a common audit procedure. So let's say, for instance, the slowest time of the year for this client is August. So you observe their inventory count in August, but your job is to say that inventory is fairly stated at the end of the fiscal year on December 31st. How can you say it's fairly stated on December 31st when you observe the inventory in August? Right. Roll forward means you're going to take the information you have in August and roll it forward to December. The way you can do that, you can do some additional testing. Like you'll go back to the warehouse in December. You're not going to do the whole thing over again, but you can do some testing of samples. You can do analytical procedures and see that the ratios are consistent from August to December. And you guys learned in 351 inventory estimation methods, right? That sound familiar? Inventory estimation? Yeah, okay. That's what they're for. Okay. You're not doing the inventory. You have the numbers for August. You use the inventory estimation calculations to see what should they be on December 31st and see how that matches up to the client's records for December 31st. Okay, and that's called roll forward testing. We do that anytime that we do interim testing. So we did some testing during the year, but we have to say that everything's okay on December 31st. So to do that, we do roll forward testing. Okay, so they do their physical count of inventory. Have any of you guys ever done that? Done inventory count for some big company? Yeah, you do it like late at night or something like that. Early in the morning, right? Okay. So you as an auditor will show up in your suit and tie and watch them give instructions and count all this stuff. So you review the client instructions. They're going to tell all these people, so this is what you do to count inventory. They'll give them like barcodes and scanners and stuff and have them writing it all down. And you watch what they're doing and make sure they're doing a good job and everything's being done carefully and accurately. They will probably stop the flow of goods. That's why they did it the slowest time of the year. You, as the auditor, can make some test counts. So, some sampling of the inventory yourself. And you can do it from the inventory listing and from the warehouse floor. What are we talking about there? That's just That's right. We're just doing vouching and tracing. You start with the accounting record, in this case, the inventory listing. It says they have this product. Then you go to the floor, look on the shelves. Do they really have this product? That's vouching. Or you can do tracing. That is, you start with the shelves. I found this product. Then you go to the inventory listing and make sure that it's there. Tracing, testing completeness. Okay, you should do both and record those counts that you do in the working papers. Okay, so you're going to listen to the instructions given to the count teams, understand the use of count tags, count sheets, scanners, RFID, whatever kind of barcodes or however they're keeping records. Be wary of hollow squares and empty boxes. What do you think that means? Right. If they want to inflate their inventory, they'll have these rows and rows of shelves with empty boxes in them. You got to watch out for that. Actually open up some boxes and look at them. Oh, I don't know. I don't know if I mentioned to you guys, but they had this webinar for professors. The firms were talking about how they train auditors. They have this interactive video game. You're doing the audit of inventory, and you tell a guy who's got a forklift, I want to see that box there. And so he goes and gets you another box and brings it down. What are you supposed to do? You, I'm sorry? Right. He gives you a different box. That's right. You have to tell him, no, no, I wanted this box. He's not going to show you an empty box. He's going to show you a box with stuff in it. So they actually test that. They want to see, do you have the guts, the stomach to be an auditor? Are you going to tell that guy, no, that's not what I wanted. I want this one. Okay, you're going to tour the shipping and receiving areas, make sure there's good security around everything. You're going to watch for obsolete or slow moving inventory. So, like if you see some stuff that looks all moldy, you're going to ask them, are you still counting that as inventory? That looks like scrap to me. Confirm inventory on consignment. Okay. What's consignment? Right. There are two ways that can work. Either you have extra space in your warehouse, so you're holding somebody else's inventory, or you don't have room in your warehouse, so you rent out space from somebody else and hold your inventory there. In either case, when you're counting the inventory, you need to know about consigned goods. If it's somebody else's in your warehouse, you need to make sure you're not counting it. And if you have stuff at some other warehouse, you need to make sure you do count that stuff, even though it's not actually there in the warehouse. So one of the first things you do as an auditor, ask them about, can I see your records of consigned goods? Make sure you're accounting for everything properly. Okay, consider the use of specialists. We talked about that. If they're a jeweler, you'll probably need help valuing the inventory and confirm inventory in transit. Okay, you guys know this. What's that about? Confirm inventory in transit. Right. We're talking about our FOB shipping, FOB destination stuff. So on December 31st, the stuff that's in the mail, who does it belong to? How do you determine that? Stuff in transit, who owns it? Whoever's paying the shipping owns it. Yeah. Right. When you're doing the valuation of inventory, it's probably some specialized good. You as a CPA don't know what it's worth. So you're going to need help from somebody. Like the example I like to use, if they're a jeweler, you don't know how much each of these little things are worth. You're going to have to hire somebody to help you. Okay, 8 o'clock. Let's take a break. We'll be back at 8:15. Okay, back in business. The attendance sheet is coming around now. Okay, special circumstances regarding inventory observation. Physical inventory count not done at year end. So this is what we just talked about. If significant time passes between the client's inventory count and balance sheet date, use roll forward procedures. That is, just like we talked about, analytical procedures, small sampling of subsequent transactions, or inventory estimation methods, like we mentioned. There's an inventory count method called cycle counts. Physical count done for different parts of inventory throughout the year. This is done when controls over inventory are strong. The auditor should check the reasonableness of procedures and observe some inventory count. Okay, so they could do an inventory count. They don't do the whole thing at once to make it less work. They do some during different times of the year. That's okay if you're convinced they have strong controls over inventory. Okay, professional inventory teams, outside specialists may be hired to perform a physical inventory count. The auditor should review qualifications, etc., as in any use of specialists. So we talked about these rules before. Anytime you need to use a specialist, you have to do some kind of background check and get references, make sure these people are reputable and can be trusted before you use them. Okay, what if the auditor is not present for the physical inventory count? Okay, we said this is a fundamental thing you should do on every audit. What if you're not able to do it? You may have to disclaim an opinion if alternative procedures cannot be performed. Okay, we mentioned this. What does that mean? You're going to disclaim an opinion. Right. You're going to write an audit report saying we cannot give an opinion. Okay, why can't you give an opinion? What's the reason for disclaiming? Right. You were not able to do the work, collect the evidence that you needed to. You say, because I was not present for the inventory count, I cannot say inventory is fairly stated. And so I cannot give an opinion. I can't do a gas audit on this company. Okay. Now, there are what are called oh, we already mentioned alternative procedures. If you can't do the test you wanted, you can do other things. For inventory, we already mentioned them. Maybe you can do inventory estimation, analytical procedures, and some sampling and inspection of inventory that does convince you in your professional judgment that inventory is okay. That is up to you. If you think that's all right, but it's your decision. You're on the line for it then if you didn't observe the inventory. Okay, here are examples of why you would need a specialist. If their inventory is lumber, you have to worry about the quality or the grade of it. Piles of sugar, you need geometric computations to figure out how much is in the silo and all this stuff. We already mentioned diamonds and jewelry, you need a specialist. These are all different examples. Pricing and valuation tests. Okay. So again, we're worried about the valuation of inventory. How do we audit that? You can look at invoices. So they should record inventory at all the costs necessary to make it ready for sale. You guys already know that rule. That would include shipping costs if they had to pay for the shipping. It could include packaging costs, whatever. You have to figure that out and determine that they properly valued the inventory. You have to worry about the assumption they used. Is it FIFO, LIFO, average cost? You need to check their accounting on that. You need to do lower of cost or market, which we talked about, check extensions and footings, and agree to the general ledger. Okay, cutoffs. We already mentioned this. Always good to go over it. Verify cutoffs for purchases and sales. Examine receiving reports and vendor sales invoices occurring around year end. Examine bills of lading and sales invoices and agree to inclusion exclusion from inventory. Okay, so we're getting down to it's going to be like sales transactions and checking completeness and cutoff testing. So if they want to move a sale forward a little bit, they shipped it out on December 28th, FOB shipping, and it arrives December 28th. That shouldn't be a sale till next year. They could just go ahead and count it as a sale this year and hope nobody notices. So one thing you can do, you can check their records for all their sales, look at the FOB shipping, FOB destination terms, and make sure that they recorded it properly. Looking at the bills of lading and invoices will tell you when it was sold, when it was shipped out, and decide whether it belongs in inventory or not. Okay. Oh, yeah, somebody was just asking me for the quiz and the exam on analytical procedures. Don't spend a lot of time memorizing a bunch of financial statement ratios. Okay, it's not necessary. I don't want you spending a lot of time on that. First of all, for the quiz, it's open book, so you can have the ratios in front of you. I think most of them are in the textbook. Second of all, the way I put together the questions, you won't really need that. I mean, you guys know the basics like current ratio and stuff like that, or debt to assets, and any ones you happen to have in your head, that's great. Use those. But the way the question I wrote the questions, you don't need to memorize a bunch of ratios. Okay, just trust me. Do not spend a bunch of time memorizing 20 financial statement ratios. Okay, not a good use of your time. So anyway, getting back to this, how would you use analytical procedures for inventory? Check the reasonableness of cost of goods sold and the gross profit margin. And as we always say, with analytical procedures, you're checking it against prior years, against their competitors, and against industry average. Check the reasonableness of ending inventory by looking at things like day sales in inventory and inventory turnover. Okay, what are some red flags that fraud could be going on with inventory? Uncontrolled access to inventory. So that's one reason you want to check security. You guys seen that movie Beverly Hills Cop with Eddie Murphy? Yeah, you remember he like just hops the fence at a warehouse and starts going through all the boxes. So that's bad security over a warehouse, over inventory. Many high dollar items with market value that is saleable on eBay. Okay, if they have things that could be easily stolen and then sold for a lot of money, you want to be cautious about that. What kind of security do they have over those? Unexpected counts during inventory. Okay, so you have the inventory listing and then you're checking it against the warehouse floor and things are not matching up. Obviously, that's a big red flag. What's going on? Large differences between counts and inventory records. Inventory shows signs of damage, obsolescence, or excess quantities. So I think we mentioned that before. You're looking at all the shelves, there's a bunch of moldy stuff there, and you ask them, are you counting this as inventory? Maybe it's scrap. Unusual interplant transfers during physical inventory or at year end. Okay, what's that about? Unusual interplant transfers. What do you think they're doing? Right. They know you're going to come to the main warehouse. So to make it look like they have enough inventory, they're going to move stuff from the smaller warehouses to the big warehouse the night before you show up. And so we talked about this when we were talking about auditing for fraud. How do you stop them from doing something like that? Don't tell them you're coming. Surprise them. That's how you deal with fraud. Okay. And reluctance of client to move merchandise to allow inspection of additional items located behind. Okay, so we were back to talking about the hollow boxes and stuff. So you say, I want to see that box back there. And they say, no, you can't see that one. That's a red flag. Um, huh. I didn't bring problems for chapter 9, so I don't actually have anything else for us to do today. Um, let's see. I'm sorry, we could have just gone without the break and gotten done a little earlier. That's all right. We're getting out early anyway. Okay. Hey, anybody want to talk about anything else? Everybody's ready for the quiz next week? Any questions about anything? All right, then make sure you sign the attendance sheet. Thank you, everybody.